Warren Buffett shocked investors when he revealed that Berkshire Hathaway is holding over $300 billion in cash, the largest cash position in company history. Most people assumed that meant he was scared of the market. But Buffett isn't scared. He's patient. And that patience holds a powerful lesson for anyone who wants to build lasting wealth. When asked why he's not investing the money, Buffett explained that opportunities don't come every day. He said that out of more than 16,000 trading days in his lifetime, only a handful truly mattered. Those were the days when the market was filled with fear, when great businesses were temporarily mispriced, and when courage was rewarded. The rest of the time, he waits. Because most of the time, the prices of stocks don't make sense. They're too expensive for the value you get in return. That patience is exactly what separates him from the crowd. Most people get excited when stock prices go up and panic when they fall. But Buffett does the opposite. When everyone's celebrating, he becomes cautious. When everyone's terrified, he becomes interested. It sounds simple, but it's one of the hardest skills in finance, staying calm while others are emotional. Buffett doesn't keep $300 billion in cash because he's afraid to invest. He keeps it because he knows that sooner or later, the market will give him a chance to buy great businesses at a fair price. Right now, he doesn't see many of those opportunities. Stocks are expensive. Real estate is inflated. Even bonds, which are supposed to be safe, have been risky because of high interest rates. So instead of chasing average returns, he waits for extraordinary ones. He compares it to baseball. Buffett says you don't need to swing at every pitch, only the ones that are perfect. Most investors swing too often and end up striking out. He'd rather stand there, bat in hand, and wait. That's what the $300 billion is for. It's not fear money, it's opportunity money. Now here's where it matters to you. Buffett's patience isn't something only billionaires can use. It's a strategy that protects regular investors from making emotional mistakes. Most people feel pressure to always be doing something, buying, trading, or chasing trends. But money grows fastest when you learn to wait for the right moment, not just any moment. Holding cash doesn't mean you're falling behind. It means you're ready. It gives you flexibility when life or the market throws surprises. Maybe a stock you've always wanted drops by half. Maybe a housing opportunity opens when no one else has savings left. Maybe you avoid taking out high-interest debt because you already prepared for emergencies. Patience turns cash into power. Buffett also said that if he were forced to invest a fixed amount every year, no matter what, that would be the dumbest thing in the world. Because you don't control the timing of opportunity, you only control your readiness for it. That's the mindset everyday savers should adopt. You can't control the economy, inflation, or interest rates, but you can control your patience, your liquidity, and your emotional discipline. So why does Buffett choose to hold cash even though inflation eats away at it? He's not ignoring that. He simply accepts a small, predictable loss to avoid a much larger one. It's like paying a small insurance premium for the right to act quickly when it matters most. He could put that $300 billion into overpriced assets and risk losing 20 or 30% when markets correct. Or he can lose a few percent to inflation and wait for the right price. He calls it a patience tax, and it's a trade he's happy to make. And unlike most people, Buffett's cash isn't sitting idle. Berkshire keeps most of it in short-term treasury bills, earning around 5%. That covers much of the inflation drag. He's not losing much, but he's gaining flexibility. That's the real goal. Cash doesn't make him rich, but it lets him act fast when everyone else is stuck. Here's how that mindset helps you directly. Let's say you're saving for investment opportunities. Instead of throwing money into the market just because it's what everyone's doing, you build your savings slowly, waiting for your moment. When prices fall, most people will panic because they're already fully invested or deep in debt. You, on the other hand, will be ready to quality assets at a discount. That's exactly how Buffett built his empire, not by predicting crashes, but by preparing for them. He's seen this play out countless times. During the financial crisis of 2008, while others were paralyzed with fear, Buffett invested billions into companies like Goldman Sachs and General Electric. He didn't panic sell like the crowd. He bought while the world was burning. 10 years later, those moves paid off massively. He didn't do it by timing the market. He did it by waiting patiently with cash until fear created value. That's why Buffett often says, you don't find out who's been swimming naked until the tide goes out. When everything's going up, everyone looks smart. But when markets fall, only those who prepared, those who kept liquidity, can act instead of panic. His approach teaches a deeper truth about wealth. Success doesn't come from predicting the next big thing. It comes from surviving long enough to recognize it when it finally appears. Buffett doesn't need to know when the market will crash. He just needs to be ready if it does. You can apply that same idea in your life. Maybe it's not about stocks. Maybe it's about keeping a strong emergency fund or saving for a down payment when rates drop, or even waiting to start a business when costs fall. The principle is universal. Patience buys power. Buffett also reminds investors that he's not trying to beat inflation with cash. He's trying to avoid overpaying for assets that don't justify their price. It's like shopping for a car. You don't buy just because you have the money. You buy when the value matches the cost. The same rule applies to investments. Most people, however, do the opposite. When prices rise, they rush in, afraid of missing out. When prices fall, they retreat, afraid of losing. That emotional cycle keeps the average investor poor and makes the patient investor rich. Buffett's strategy breaks that cycle. He doesn't chase what's hot, he studies, he waits, and he prepares. His wealth wasn't built by being first, it was built by being right. That's the part most people miss. They look at Buffett's billions and think, I could never do that. But his edge isn't size, it's discipline. Whether you have $500 or $500,000, the principle is the same. Don't rush, don't panic, and don't let the system trick you into confusing comfort with safety. When rates are high, people feel safe holding cash. When rates fall, they feel safe buying stocks. The truth is, both moments have risk. The key is knowing which one gives you control. Buffett uses high-rate periods to gather strength, then deploys it when rates fall and everyone else is caught off guard. You can do that on your own scale, by saving when others overspend, by planning when others guess. At some point, interest rates will come down, inflation will ease, fear will return. And that's when Buffett's $300 billion will transform from idle cash into opportunity capital. When everyone else is selling to survive, he'll be buying to grow. That's how he's done it for decades, quietly, patiently, predictably. For you, the takeaway is simple. You don't need billions to benefit from Buffett's logic. You just need the mindset. Keep some liquidity. Stay curious. Study value instead of headlines. Be okay with waiting. Because waiting is not a weakness, it's a strategy. The market will always test your patience. It rewards those who think long-term and punishes those who react short-term. Buffett knows this better than anyone. His $300 billion isn't a symbol of fear. It's a masterclass in control. And maybe that's the biggest lesson of all. The goal of wealth isn't just to make more money. It's to stay in control of your decisions, especially when the world around you loses its mind.